Hey, welcome to the Worry Free Financial Podcast. My name's Eric Ebers, and as always, my goal is to help make finances worry free for you. One of the things I'll talk about is a little bit about the economy, a few other just tips about saving money, investing, insurance, things like that. I'll be talking a little bit today about budgeting and some of the main reasons people fail to have a successful budget. And then I've got a Q&A question that I will be answering as well. So let's go ahead and dive into our economy update. And um, one of the things I want to just talk a little about is that there is talks about stimulus check number 2 circling around. And I do think at some point we're going to see stimulus check 2. I just think there's too much division right now in terms of what that package includes. I don't think that's going to come out for several weeks or months at this point. But stay tuned. I'll continue to provide updates as I hear of them. The thing that's the most surprising, I think, right now is between the amount of civil unrest in our nation in wake of the George Floyd killing and having such a high unemployment rate, the way the stock market's been performing does not align at all with what we're seeing with events in the United States. So it doesn't make sense why the stock market's been performing so well. It may continue to. I still feel like it's got to come down before we revisit the all-time highs that we saw in February, which we're only about 7% from those right now. But we'll see what happens. I don't know all the answers to that, but I'm continuing to just do what I've always done with my retirement contributions and continuing to invest at this point. But let's move on to our money saving tip. One of the things I think a lot of people are doing right now with with people staying at home, working from home, a lot more takeout potentially, and just reducing the amount of meals you purchase throughout the week by 2 meals will save you about $1,000 a year if you were to just make your own lunch or your own dinner. So consider making that shift to give yourself a raise. With real estate, we're seeing about 10% of mortgages now in forbearance. And what forbearance means is that they have worked with their mortgage lender and they will not be paying a mortgage for a couple of months. And it seems to be the most likely scenario of what will happen is at the end of that 3-4 month period, they'll owe all 4 months of mortgages. So it may be giving you temporary relief, but you're going to be into potentially sticky situation here in a couple of months. So I would recommend not putting your mortgage in forbearance unless you absolutely are to that point where you have to be able to have food on the table. One other thing is with that, there probably will be an uptick in foreclosures, which may have some impact on the housing market down the road. Refinance opportunities are still there. I think they'll be there for a little while still, but right now we're looking at for a 30-year fixed loan, conventional loan, you're looking at about 2.5% to 3% rate, depending on credit score, the amount you're borrowing, and a few other factors. I am a mortgage loan originator. If you have questions, you can email me at eric@ccm.loans, and I'd be happy to answer questions, help you determine whether it's the right choice for you as well. So we can take a look at that. I'll have that information in the video description as well. In terms of insurance, there's something interesting going on right now. The IRS has approved the ability, if employers choose to do so, to make mid-year election changes with your health insurance. And I think the biggest area where this is going to impact is people that have a flexible spending account. You may have heard of it as kind of the use it or lose it account because you put a certain amount in there a year for tax-free health care. And if you don't use it, you lose that. But that may be an opportunity, especially with maybe you had an elective surgery planned this year, and with all the COVID-19 stuff going on, you had to cancel that because they weren't doing elective surgeries. you have the potential to shift some of those elections and maybe not lose some of that money that you might have lost otherwise. In terms of investing, one thing that um, I would recommend this as a potential way for you guys to, if you own stock, especially if you already give charitable contributions, consider donating stocks as part of that. If you've owned those stocks for over a year and you donate them, those gains are non-taxable now. So you're getting the tax benefit of whatever you donated normally, plus you're not having to pay taxes on the gains you had on those stocks. And so it's a really good tax advantageous way to give. Um, but let's go ahead and move into budgeting. I had mentioned last week I was actually going to walk through a budget, but instead I decided to choose 6 key areas of budgeting that um, from financial coaching that I've done in the past seem to be the most common reasons people fail at having a budget. Number one is variable income. So people that maybe make different money from month to month, different amount of money, they struggle to figure out how am I going to even account for that in a budget. And what I recommend is to take 3 or 4, maybe your last 3 or 4 months, look at what your income was for each of those months, and then take the lowest month. And that's what you use for your budget. Anything that you end up making above that, you can choose to allocate to certain areas of your budget accordingly. So if you're paying down debt, maybe you want to say, I made $500 extra this month, I'm going to pay off $500 more of debt. If you're building an emergency fund, maybe it's saving $500 there. Or if it's retirement, put it into retirement. So those are just some ideas with that. But plan for your lowest month, and when you make anything more than that, it's just an added bonus, and then you can figure out where you want to allocate that money. Another thing that just seems to be in general a struggle is just finding a system that works, whether that's a spreadsheet, whether that's a app. There's all kinds of different tools out there. One really good app I recommend is EveryDollar. Um, it's just a very simple budgeting app, but there are tons of budgeting apps and tools out there. Just find whatever works for you on that. And then the other part to kind of thinking of it as a system is if you tend to overspend in certain areas, consider doing a cash-based system for those instead of maybe you get your groceries and you tend to get more than what you plan for. You maybe get walking down the aisles and you see the sales at the end of the aisle and you fall for that without planning for it. Maybe that's a way for you to say, oh, I don't have the money for it. I've got cash. I've got $200 in cash. That's all I can get for groceries. Anything else beyond that, I've got to put back. So that works. You can't possibly go over your budget if you only have enough money to buy things that are in your budget for. Another issue is just using your past expense to determine your budget. So maybe you just decided I'm going to just pull 3 months of bank history and that's my budget. Um, you can't just assume that what you've done in the last 3 months is good spending. So maybe go through and try and determine what's a want versus what's a need. It's okay to have things that you want in your budget, but not if it takes away from the things that you need. So put your needs first, and then when there's extra, you can do some of your wants and make sure you're having some fun with it as well. But if you do struggle to maybe with sporadic spending or things like that, some other tips, maybe try keeping a list for 3 or 4 weeks of just this is what I'm spending on a daily basis. Every time you make a purchase, you write that down, and then you're going to write, is that a need or is that a want? You'll see that after a few weeks, you're going to start to be more hesitant to purchase the things that you're classifying as a want versus a need. 3 weeks is enough time for you to develop habits. So consider that, or consider even doing like a 3-week financial fast where you absolutely don't purchase anything unless you need it. You maybe choose to go through your pantry and be creative with creating meals rather than going to the grocery store or ordering out. So there's just some tips for you to maybe, if you struggle with overspending, to overcome that. Next is just forgetting things. If you've got pets, remember that you've got to provide for pet food, for If you've got a cat, you probably need cat litter. Other things like that that maybe just you don't think about when you're putting your budget together. Make sure that you're thinking about those things. Another one is just staying disciplined. You need to make sure that you are doing this every single month, that you're staying focused. You have goals that you're gonna accomplish by doing that. Um, Another thing I think is huge is being able to see the future impact of what you're doing today. So thinking by making this sacrifice right now, does that mean that I could retire a year or two earlier? Does that mean that I could go on this vacation? Just be really even put that into perspective. Try and calculate even like, okay, if I get a $5 Starbucks every day, what does that equate to over the year, a course of a full year? And you're talking $1,500 that you could have spent on something else. And so just processing like, what does something small that adds up eliminate you from being able to do? And then having an emergency fund is the last one. A lot of people, their budgets get ruined when they have an emergency that they don't have funds available for to help cover that cost. And so that emergency happens, and all of a sudden you've got more debt, and now that blows your budget because now you've got debt payments that you didn't plan on before in previous months. And so that is another area. We're going to go ahead and move on to a Q&A. And this is a real person. I've changed the names, but this is just a scenario I think is a really good way to just kind of get people thinking about how can we process different scenarios. So Jane and Jim are asking, what's better, working towards paying off our student loans or doing a refinance from a 30-year to a 15-year term? So there's some things we need to know to be able to do that. And so some of the things that we would need to ask for that is we need to know the current amount owed on the home. In this case, it's $180,000, their current monthly payment, and their current interest rate. You can get all of that off their mortgage statement. We would need to know current student loan balance, what the monthly payment is for those student loans, what the interest rate is, and what's the payback period for that. And you should be able to find a student loan statement for that. You'll need to know if you're looking at that 15-year loan, you need to know what that new loan interest rate is, what the cost to refinance is. In this case, I'm conservatively saying that it would be $10,000. And then the amount of time that you expect to spend in your home. If you don't expect to stay in your home for more than a few more years, a refinance is kind of off the table because you're going to take at least a couple of years to break even on the cost of the refinance before you're starting to see the benefit. So there's something to just keep in mind there. Another thing, if you went down from a 30-year to a 15-year loan, you're going to save a ton of money over the course of the loan, but you are going to also most likely have a higher monthly payment unless you have a very high interest rate right now. I mentioned previously that you're looking at probably a 2.5% to 3% interest rate for a 30-year loan, and even less than that potentially for 15. And then as I just kind of look at this chart, I'll talk through that, but I highlighted two of the areas in gray, and you can see that those two would go together. So if you continued to have your current loan and you had the additional, what I calculated, $341 a month is what the increase would be by going down to a 15-year loan. If you put the 341 towards your student loans, that would be, those two would go hand in hand. All the others are kind of standalone scenarios. So just looking at interest rates, I'll just talk through this real quick. So their current home interest rate was 3.75%. I'm saying that they would qualify for a 2.5% interest rate on the 15-year loan, and their student loan interest rate is 4.75%. And so I think a lot of people would automatically think that, oh, I've got the most money saving potential on my student loans because of the interest rate. And in some situations that's true. If you're just comparing credit cards, you're probably right there. But in this case, we're going to look at that and see if that holds true. And so first, I'm going to just kind of talk through the current scenario. So they have about 25 years left on this mortgage, and they owe 200, or the total cost of the 180,000 they owe will be 277,870. They'll pay it off in 300 months. The monthly payment right now is $926 at that 3.75% interest rate. Okay, so let's slide over and look at the 15-year option there. So if you went down to the 15-year loan, I'm saying that their actual loan amount, instead of being $180,000, the amount owed, it would end up being $190,000 because of the cost of the refinance. The total cost then for them to pay off this loan is $228,000, so almost $50,000 less than the current option. They'll pay it off in 15 years, 180 months. Their monthly payment will go up to $1,267, which is a $341 increase per month, and that interest rate's 2.5%. You'll break even on the interest rate cost, or the refinance cost, with your interest savings within 5 years. And really, that's pretty significant savings if they can afford the $341 per month. And so the rest of this scenario is assuming that if they took $341 and applied them to any one place, that they will that they'll be able to pay those off, and we'll see which scenario is the best. And so you can look at their current mortgage with $341 added to that. You can see that they can still save quite a bit there, but not as much as the 15-year option. The one benefit is they do have flexibility on whether they're going to make that extra payment or not. They can't pay it off quite as quick. They're about $10,000 more expensive than what they would have been with the 15-year option, and they stay at that 3.75%. If you were to just look at trying to pay down those student loans faster by putting $341 extra into those per month, you're going to only save about $3,500 over those 3 years, 4 months to pay that off. And so if you're to just compare weekly savings, you're definitely saving significantly more by going with the 15-year rate. And so if this was my client, I would be recommending that they consider, if they have the ability to make the $341 per month extra, to go ahead and do that. There's obviously some other scenarios you'd want to look at in terms of what other debt, if there's any other debt. We wouldn't just jump into this scenario without looking at what's the rest of their financial scenario. But this is just if they're asking just between these two situations and assuming they've got the money, definitely a better option to go down to that 15-year loan and save $50,000 over the term of the loan. So that's really all I had for today. I hope that was helpful. I hope that was interesting. If you have financial coaching questions, email me at worryfreefinancial@gmail.com. If you have mortgage related questions, you can email me at eric@ccm.loans. Don't forget to subscribe, and I will see you guys next week. Thank you so much.